Now, see, there's the stop that we didn't have last week. Go ahead, Jean. And everybody, make sure you put your questions in the question box. Click your plus sign next to questions to be able to get to the question box. Go ahead, Jean.
If you have any questions, you need to ask them now. Once we get started, or if you have questions later on. Can you see the screen now?
I see your screen and everybody else should see it.
Okay, is it clear? Have you got a clear picture?
Yeah, all your little icons are there.
Okay, but can you see the document I have up on the screen?
There, I see just your desktop.
Well, I got a document open. It says modified carryover basis. Can you see that?
No. I do not see your document. I just see your desktop.
Can you see it now?
No.
How about now?
No.
How about now?
No. Oh, wait a minute. I got to start the broadcast. There it's coming.
The broadcast is now starting. All attendees are in listen-only mode.
Now they should be able to see.
Can
I see part of your document.
Can you see it now?
You got to move it over. Move it over some more. There you go. Now we see it.
So it's got to be to the left for you to see it.
Right.
Can you see it clearly? Is it clear?
I can see it and I can read it. And I'll do that. You want me to start reading it?
Yeah, read this. This is written by attorneys.
Okay, modified carryover basis rules of IRC section 1022, current implications. With the repeal of the federal estate tax and generation skipping transfer tax comes the new modified carryover basis. Prior to the repeal of the federal estate tax, beneficiaries of an estate received a step-up in the basis of property they inherited from the decedent. New in 2010, beneficiaries will inherit property under the new modified carryover basis rules. What is the basis of property? For income tax purposes, the basis of an asset means what was paid for the asset plus the value of certain improvements. In the case of stocks and bonds, the basis simply equals the purchase price, while with real estate, the basis equals the purchase price plus the value of all capital improvements. What is the step-up in basis? Prior to the repeal of the federal estate tax on January 1, 2010, beneficiaries of an estate received a step-up in the basis of the assets they inherited from the decedent. A step-up in basis means that regardless of what the decedent paid for the asset, the heirs inherited the asset at fair market value on the decedent's date of death. In other words, if a decedent paid $3 million for a piece of real estate and did not make any capital improvements to it, and the date of death fair market value of real estate increased to $5 million, then the heirs inherited the property with a stepped-up income tax basis of $5 million. You got to move it up for me to continue. What is the step up in basis? Oh, let me see. Go up just a little bit. There we go. What is modified carryover basis? With the repeal of the federal estate tax, a new modified carryover basis is instituted. What this means for decedents who die on or after January 1, 2010 is that their heirs will inherit the decedent's original income tax basis in the decedent's property plus the value of certain improvements, not a full step up in basis. In other words, if a decedent paid $3 million for real estate and did not make any capital improvements to it, the date of death fair market value in 2010 increased to $5 million. The heirs will inherit the property with a carryover income tax basis of $3 million. That doesn't make any sense, but we'll continue. Even so, the carryover basis is subject to adjustment under the new modified carryover basis rules. Under these rules, the basis of assets passing directly to a surviving spouse or into a qualified term enable interest property trust or QTIP trust for the benefit of the surviving spouse can be increased by $3 million, while the basis of assets passing to a non-spousal beneficiary can be increased by $1,300,000. Put that in kindergarten language, Jean.
It means that if you have, when you die, your estate has a assessed valuation for the heirs or the beneficiaries of the estate. Now, if you didn't make any capital improvements to the estate, then they inherit it at the market value, whatever that is at the time of the death of the decedent, the person that died and whose estate passed. That's what that means. So if you have if you inherited at this person's death and it has a market value of $3 million, and then it goes up $2 million in valuation, and you've got a $5 million market, then you have a $2 million step up in income. See, they value it in income. That's how they collect the tax, the generation skipping transfer, which is an income tax.
Okay, do you want me to keep reading?
Yeah, start reading up here at the top.
Okay, thus, if the new non-spouse beneficiary sells the property with a modified carryover basis of $4,300,000 shortly after the decedent's death for $5 million, then the non-spouse beneficiary will owe capital gains on the net gains of $700,000, which is the difference between the sales price and the non-spouse beneficiary's modified carryover basis. Contrast this with the sale of an asset under prior estate tax laws, which provide for a full step-up in basis to the beneficiary. Under prior estate tax laws, the basis of the property would be stepped up to a fair market value of $5 million, so that the sale would not generate any capital gains taxes to the beneficiary. Under the new modified carryover basis rules, $700,000 net gain will now be subject to capital gains tax, currently 15%, but soon to increase to probably 5%, under Obama's regime, as well as state income tax on the capital gain.
That's 25%.
Huh?
It's going to increase to 25%.
Right. In this example, $700,000 net gain times 15% equals $105,000 in federal income taxes, and add another 5% state income tax on the net gain, which is $35,000. The total income tax liability to the beneficiary is a staggering $140,000. Quite a contrast from the prior estate tax law. Fiduciary's dilemma. Move it up a little bit, please. For small estates, the basis increase rules will permit the basis of eligible property to be increased to fair market value on the date of death. However, if the basis increase amount is less than the unrealized appreciation on the eligible property, the basis increase must be allocated among the eligible property. Under the rules, the executor has the direct discretion to allocate the basis increased to eligible property on an asset-by-asset basis. The only restriction on the executor's discretion is the ceiling rule, which provides that the basis of an asset cannot be increased above its fair market value on the date of death. If there are multiple beneficiaries, then the executor's fiduciary obligation to all beneficiaries can present a couple of problems. In such cases, the act of allocating basis to property bequeathed to one beneficiary cannot be construed as a breach of the executor's fiduciary duty to the other beneficiaries. Guidelines under the decedent's will as to how the basis adjustment, if any, should be allocated may prevent such a dilemma. If no guidance exists under the decedent's will, it would be prudent for the executor to obtain the consent of all beneficiaries to a basis allocation scheme prior to its implementation. What action will, do you want to go back and explain that a little bit, Jean?
Well, what they've done is they've changed the rules. The rule, they repeal, in 2010, they repealed the Class 5 gift and estate tax. Then they reenacted it on January 1st, 2011. And they've changed the, in other words, if the value, because of inflation, the value of the estate goes up, and that's what they mean by carryover basis.
Okay. What action?
It's an alternate valuation because there's a valuation at the time of the decedent's death, 6 months after the decedent's death, and at the time of the transfer, exchange, or sale of the estate property. So you have three different valuations, alternate valuations, under 2032A of Title 26. You have the value of the estate at the time of the death of the decedent. That's number one. Number two is you have the value of the estate 6 months after the decedent's death. And number three, you have a value of the decedent's estate at the time of an exchange, a sale, or a transfer of the estate property. So you've got three separate alternate valuations. That's what they mean. And that's what they're selling your estate, which is what that all capital letter name is. Now you know why you can't write an executor letter unless you understand tax law.
Right.
David Clarence is trying to write executor letters without understanding this. That's why I'm repeating this from the prior class. You got to understand this. Everybody's going to get a copy of this so they can study it. I don't expect you to understand this stuff.
Okay, so class. Are we going? We're going to be able to upload this document to our attendees.
Yes, I'm going to give them this. I got another document that I put together. I was up till 5 o'clock in the morning putting it together, which explains what's going on with these mortgages. And I'm going to go over it. It's about 30, 40 pages long. And it shows you exactly what they're doing with these mortgages.
Okay.
It's a tax issue, nothing else.
Okay, so you'll be getting that to me so that I can put it out on the file transfers so that everybody can get that.
Yes.
Okay.
I'm going to give you this document and the other one, and there's a memorandum in here.
Okay.
You have to understand tax law. This involves, because an estate is a trust in essence, you have to understand trust law. When you're talking about fiduciary trustees, beneficiaries, and heirs, you're talking about a trust.
Yeah.
Trust law. You got to understand trust law, and you got to understand tax law. Okay. And then you get in all these different aspects. Commercial law, trust law, and tax law are all interrelated. They're all connected together. You can't understand one without the other because they're all functioning together. simultaneously.
Okay.
And at different, and sometimes they operate at different levels. And then you get into accounting. Then accounting comes into play when you get into these mortgages. If you don't understand the accounting, you can't understand anything that's going on. That's why we're filing these. We just filed a claim for $1,408,000 on the estate. We're making a claim. We're taking the 30-year maturity of the security, which you call a note. We multiply the 30 times the amount of the payments, and you come up with an that's the alternate valuation that they're talking about here. So what you have is an alternate valuation of the estate at maturity, which is, in this particular case, it was $1,408,000. So we're making an adverse claim to $1,408,000.
Okay.
Does everybody understand that?
And let me see. We have some questions. Let me read the questions. We have quite a few questions. Hold on just a minute. So when the bank receives the security at closing, that becomes the basis, right?
That's the, and then the carryover basis is the value of the estate at maturity.
Okay, and when they foreclose, is the basis the same?
No, well, yes, it's already, they've already had the funds advanced. That was the value of the estate at maturity.
Okay.
That's why it says under payments, it says you can make up any differences. See, this loan is not in default until maturity, and it says that in Section 3 under payments. It says if there's any deficiencies owed on the mortgage payments, they can be paid at maturity. That's a part of your agreement. So how can the loan be in default?
Yep,
well, I'm going to show you why it's in default. The reason it's in default is they never transferred the loan to the REMIC or the trust fund, and I'm going to prove it to you.
Okay.
That's what they're doing.
All right, let's go on. If you file a 1040 every year, do you have a new date of death every year?
No.
No.
What you have is a valuation of the estate at exchange, sale, or transfer.
Okay, so what our attendees are going to get is a copy of an adverse claim document that you've prepared for our attendees.
Well, I'm laying the foundation so that you got to understand what you're doing. You can't do paperwork until you understand the taxes.
I'm just reading the questions. So you add the payments to the original basis up to the time of the claim.
Right. That's the value.
Go ahead.
That's the value of the estate at maturity.
Okay.
That's a carryover basis. That's what they're telling you here. But nobody's doing this because they don't understand. We're making a claim on this.
Okay.
It's a carryover basis.
And that's what our attendees are going to learn how to make that claim.
Right. That's what the adverse claim is.
Which is the adverse claim. Okay, go ahead. You want me to keep reading or?
Well, yeah.
All right. The first option, let me see. What action will Congress take in 2010? Since Congress has allowed the estate tax to disappear, there are three very different paths for Congress to take at this point. One, the first option is to do absolutely nothing. Under this scenario, the estate tax will return on January 1, 2011 with a $1 million exemption and a 55% tax rate. The generation skipping transfer tax will also reappear with a $1 million exemption that will be indexed for inflation in 2011 and beyond. This would be disaster. Instead of paying no estate tax on $3,500,000 estate, reverting back to an old estate tax exemption of $1 million, the estate tax liability will be $3,500,000 estate will be $1,375,000. That is a significant difference which generates more revenues for Uncle Sam. Number 2, the second option is Congress will act prior to the date that the first 2010 estate tax return is due, which is on or before September 1, 2010, to reinstate the estate tax retroactively back to January 1, 2010. The big issue with this option is that it is unclear whether applying the tax retroactively will be constitutional, which in turn will lead to one or more lawsuits that could take years to unravel. Number 3, the third option is for Congress to act in 2010 to reinstate the estate tax, but only apply it to the estates of decedents who die on or after the effective date of the new law. This option could potentially provide a windfall for wealthy decedents who die during the period while the estate tax is repealed, particularly if their estate passes to a surviving spouse and or is comprised of assets with a high income tax basis. As taxpayers, until Congress acts to resolve this mess, it would be in everyone's best interest, whether single or married, to revise your existing estate planning documents to include the necessary discretionary language to protect one's interests with regard to the new modified carryover basis rules. For more information on these options, please contact. Do you want that name said?
Yeah, go ahead.
John R. Lolio, Lolio, Jr., Esquire, at 856-661-2094, or email him at JLOLIO at SHERMANSILVERSTEIN.com.
Now that's the guy, that's the lawyer that wrote this. This is a big law firm that specializes in gift and estate taxes.
Okay.
Now you see why people are not getting anywhere, because when you get into a foreclosure situation, you're involved in an estate tax, a gift and estate tax. And if you don't know, I'm going to show you what you can do. All the power. You have all the power and you're not asserting it. That's why you're not winning these court cases.
That's what we're trying to learn how to do.
You can make them parachute out the window. I'm telling you, you have no idea how important. This is the most important information that you will ever learn. Now I'm going to show you.
Let's take a couple more questions.
Okay.
I got to get back to the one. Wait a minute, we're missing some. I'm in the claim. People are asking how many. I will let Jean go through these other questions. You guys, you don't need to keep asking how many sessions will it take. How will we get the adverse claim? Will making the adverse claim be applicable to criminal indictments, especially one that's 20 years old?
Yes, because it's civil.
What happens?
They're probating.
Go ahead.
Because they're probating your estate.
And will the adverse claim that our attendees will be given? Will it be easy? Will they get to modify for a criminal situation?
Yes.
Okay. What happens if you have a mortgage where the interest changed 3 times during the length of the mortgage?
That's because you have triple noting. And you can claim all that. But you have to know how to do it.
Okay. That's what we're here to learn. Now somebody's saying just summarizes, don't read the whole document. That's why we get copies of the webinar, to be able to read them. If it's on the transcripts, the people that are getting the audios, that's why we're reading everything. So we should go into the courtroom and hand out parachute. Oh, come on, guys. That's a silly question. If you want to learn the information, get decent questions. You don't hand out parachutes. You learn what to do.
Okay, this is publication 950. Now they're probably going to update this. And you can see this is what they're taxing you.
And where is publication 950?
It's an IRS publication. You can download it off the internet.
Okay.
Just type in publication 950 and it'll pop right up.
Okay.
I just did it.
All right.
Okay, I'm going to go over this. On the gift side, you've got in 2002, you have a $345,800. So you've got all these people out there filing 1040 tax returns on W-2s and W-4s. They're paying income tax on their wages when they have a $345,800 exclusion. You got 330 million people filing 1040 tax returns, and they don't even know what a 1040 tax return is. You don't file you don't file taxes, estate taxes, on a 1040 form. You do it on a 706 or a 709. If it's a gift, you do it on a 709. The exclusion, I can take you and show you the form. If you want me to show you the form, I'll show you. The Unified Tax Credit is built right into the form.
Okay, so let's go through this one here right now, and then come back to the 706 and the 709.
Okay, you got a Unified Tax Credit of $345,800. It remains steadily the same. And they show it up to 2009. And the reason is that it was repealed. They repealed it from 2010 to 2011. But now it's been reenacted as of January of this year. January 1st, 2011. It's been reenacted. So now you have I'm just showing you what all this tax credit, corporations use tax credit as money. This is what the DTC, all of these people are taking this money that you're not using, these tax credits, and they're spending it as money.
So we can apply for these unified credits in this particular example, 2002 and 3 to 345,800, 2004 and 5, 555,800, 2006, 7, and 8, 780,800, and in 2009, 1,455,800. So that's what people gave away when they did not, or they can, that needs to be claimed. Now that people are going to learn how to do it.
That's what you gave up when you filed the 1040 form.
Can we go back and get those under an amended form?
Yes. Yes, you can. So you see the difference? You've got a $1 million exclusion on the gift side. You've got a $3,500,000 exclusion on the estate side. You see the difference?
Wait a minute. Do you add those together?
Well, yeah, you can claim, you've got $4,500,000. You have
Okay.
both a gift tax and an estate tax.
So the applicable exclusion amounts that
What
so
was
then,
what,
so then in
what was the
2000
gift? The gift was the donation when you gave them the note.
Okay.
Let's just talk about you had a mortgage. What
I
was the
had a
amount of your
mortgage.
mortgage?
It was 200,000.
Okay, so you gave a gift of 200,000.
And I got $1 million credit?
You have a $1 million exclusion, so you don't owe any taxes on that.
So I don't owe anything on the 200,000.
Right. But you didn't claim it.
When they came and kicked me off the land, now I can go back because I didn't file any 1040s for 30-some years.
You can
So I
go back.
can go back and do an amended one.
Yeah, you can do an amended complaint and get all that money back.
Oh my golly gee.
What they're doing is billing you for they're doing a forfeiture. What does the complaint say? When they do a foreclosure, they do a forfeiture. What is a forfeiture? It's a seizure, a forfeiture, and a seizure of taxes because you did not report this on your return as income to the person who was the recipient of it.
Okay.
So what they did is they did a forgiveness since they forfeited the property. Since you lost the property as a forfeiture, they do a 1099-C and do a forfeiture or a forgiveness of indebtedness. They took your property in lieu of the payments. So now you have forgiveness of indebtedness, which is taxable income. Now in addition to losing the property, you now have to pay for the forgiveness of indebtedness, which is income. In other words, the amount that was forgiven is what you owe in income. Now the IRS is going to come after you. So you not only lost your home, you got to pay the taxes on the forgiveness of indebtedness.
But we can go back and undo all of that.
Yes, you can.
Okay.
But
Question.
you can't do that unless you know what you're doing.
Okay. Question on the board. You said a 1040 form is an estate tax form. I don't understand why you would not use the 1040 for the estate tax. Please explain.
Well, because it's an income form, not a gift and estate tax form.
Okay.
That's why. I'm going to
Because
show you.
We use the wrong form.
You're using the wrong forms. I'm going to show you.
Okay. If there's a tax credit, do we get to collect the balance of the credit after other deductions? How? Okay, Jean is going through this, attendees. Listen carefully, because we've all been filing the 1040 forms wrongfully for eons. Now we can go back and do amended. We can do complaints to amend, and we can reclaim everything that they took away from us or that we had coming that we did not know about. Right, Jean?
Yeah, you can get all this money back that they've been using. They've been stealing from you.
And these are on the mortgage notes. Does it apply to everything else besides a mortgage note?
Yes.
Okay, we got a question on the board. Have you done this for yourself, or is there someone else that's done this that could show some firsthand experience?
Yes, I have done this. Yes, I can show you. I know how to do all this. Here's the 709.
Okay.
Now this is what does this say? But you got to understand what you're doing so you'll know how to fill the form out.
United States gift and generation skipping. I can't see the rest of it.
Let me reduce it down.
Skipping transfer tax return, 2010.
Notice your maximum unified credit is
Line
330,800.
And that came off of that other form that you said to look up. To Google the publication 950.
It came off publication 9, but this is, see, they've changed it. They've reduced, this is 2010 now.
Yeah.
They've repealed the Class 5 gift and estate tax, and they reenacted it. So they're going to come out with a different, this is why they're showing a different amount here.
Okay. So then
They've
where
reduced,
you put 00 on the form, generations, skipping transfer taxes from Schedule C, is that the 00?
where are you at?
I'm on line 16, down where the zeros are. To the right, to the right, to the right.
Yeah, right there.
Okay, over to the right there, 16, yeah.
Yeah, you got 000. There's your tax credit right there. You have to make over and above that to have a tax liability.
So
you show me anybody that's a wage earner that's making over $330,000 a year.
That's why you only put the two figures on the 1040. The unified tax credit, and on this form, and what you deduct, anything over and above 330,800 is what goes on line 16. Anything above. In other words, if you had 500,000 and you deducted 330,800 on line 16 would be the difference, right?
Yes.
Okay. All right. What is the gift in property tax cases? The note, folks, the note.
Okay, let me save, I'm going to save this to my desktop.
Okay, let's take another question here while you're doing that. What happens to the 1040, for example, 2004? How do you fix it and bring it back and fix it? That's with an amended filing, guys. You have to go back and amend it, and you have to make your claim. And Jean is going to be helping us with the adverse claim. I think it's all going to be a package that we're going to put together, and you're going to get it where it needs to go. Somebody's asking to come back to the W-2s. They always say you have to staple a W-2 to the 1040. It doesn't matter because the W-2 is far less than the exemption, right, Jean?
Yeah, you don't file 1040s on a Class 5 gift and estate tax.
You file the 706. And you attach the
oh
W-2s to the 706? Am I way off? You attach your W-2s to the 706 form.
This is the form 706. This is the estate tax return for reporting estate taxes on the estate.
Okay, which do you staple the W-2s to? The 706, the 709?
The 709.
The 709 gets the W-2s attached to it. Listen to that carefully, folks. You staple your W-2s to the 709 form, not the 706 form. Continue.
Okay, let me ask you a question. When you're working for an hourly wage, who is the donor?
Me.
No, you're not. The employer's the donor.
Why?
He's giving you the money. He has to pay the tax.
As a donor, he pays the tax, or as a business, he pays the tax?
That doesn't have anything to do with it. It's a donation. Why do you think they call tips gratuities? They've got the waitress is paying the taxes when the donor should pay them. Because she doesn't understand what's going on, she's paying taxes that she doesn't owe.
Okay. So
this is
now,
what happens when you...
let's come back and slow this down just a little bit so that people can understand it.
Can you see this form?
706.
Yeah. Okay.
What's the important line on 706?
Well, you got number one. You got your total gross estate less exclusion. You've got your exclusion, which is $3,500,000.
And so then on line 1, you put $3,500,000.
Right. That's your total gross exclusion.
Okay, allowable
estate.
deductions is everything over $3,500,000.
Yes, that's what your taxable income is.
Okay.
Then it goes up to, it's 55% of the amount over, but you have to go in. They have a table that shows you how you compute the tax.
Where do you find the table? With the form?
Well, it's in, you want me to show you it?
Yes.
Okay, is everybody, you've seen this, I'm going to save this. We're going to give you these forms to study. Does everybody understand so far what we're doing?
Let's see if there's a few more questions here. Somebody's saying how far back can you go? Is 3 years the maximum?
No, that's on a 1040.
That's only on a 1040.
Yeah, on a
Who do you
Class
give
5 gift. There is no statute of limitations on a Class 5 gift and estate tax.
Who do you give these adverse claims with these on these older accounts? Who do you give the claims to or against?
Well, when we get these forms out, we'll go into all that. You're getting ahead of the horse. Right now, we're addressing the issue of taxes on gifts, on W-2s and W-4s. W-2s and W-4s are Class 5 gift and estate taxes.
Okay, so there's no time limit to go back and amend what you did.
There's no statute of limitations on a Class 5 gift and estate tax.
Okay.
As long as you got an OID, you can go back.
So
you can go back. You can go. There's no statute of limitations on it.
Okay. And do you just mark the 709 or 706 as amended when you do that?
Yeah, you can use it as an amended return. Yeah.
Okay, is it the same for property taxes?
Yes, that's part of your estate, isn't it?
Okay. Okay, it says here, the attendees don't understand that W-2 and W-4 and 1099 are estate tax forms, which is why the 709 is used instead of the 1040. And of course, this info is discussed in Internal Revenue Manual 6209. Okay,
Well,
I'll pay. Go ahead, Jean.
well, we can.
Well, let me continue here. I pay $80,000 in property tax. What do I fill out on the form? Which one? And am I the donor?
You're the donor. You donated the property. They're supposed to pay the tax, but they're making you pay it.
Okay.
Well,
So
let me before I go into this, let me show you something.
okay.
Because this explains this, and this will answer your questions.
Okay. All right. Okay, one of our people is saying you do not put the exemption as gross estate value.
No,
Why?
because that's not what the exclusion is how much they give you that you don't have to pay taxes on.
Okay.
So if your estate is if you have a $3,500,000 and your estate's worth $5 million, then you only have to pay the difference between $350,000 and $5 million.
Okay.
Or $3,500,000 and $5 million.
Okay. So what if you're self-employed?
It doesn't make any difference. You got it depends on what you're making, but nobody's making that kind of money.
So regardless, a self-employed person would not really have any self-employment tax, would they?
No.
Because they have to take everything they make on their books and calculate it against that unified tax exemption amount. And what they're taxed on is anything over that $4.5 million. Right?
Right. Right.
So if you are a self-employed person and say you've grossed or you've netted, whichever way you feel, I don't know how you do it, but let's say you made $40,000 or even $150,000. That $150,000 would be deducted off of the $3,500,000 and which added to with the $1 million added to it makes it $4.5 million minus $150,000, right?
Right.
Okay. So
This explains the gift and estate tax.
okay.
Can you see the document?
I can read it. You want me to start reading?
Yes.
To William P. Strong from Taylor Clatt. Re. Net gift arrangements, substantive and procedural. Questions presented. Whether a donee transferee of the net gift may successfully control the gift tax payment procedures relating to the net gift transfer, particularly in relation to 26 United States Code 2502, subsection C, 1986, which establishes donor liability for gift taxes, whether a trust vehicle will cause additional problems in structuring a net gift transaction. 3. What are the procedure requirements for filing the gift tax transactions? Background. Broadly, a net gift is an estate planning device where a donor transfers an asset to another party, generally but not always a family member or trust. And the transfer.
Okay. So the net gift was the mortgage loan that you made, the note that you gave to the lender.
And that was the gift that we gave, but we can go back and reclaim it.
Go ahead and finish.
Okay. And and the transferee agrees to pay the donor's associated gift tax liability. The usual
Okay,
purpose...
read that again. Read that again. Who's the transferee
The transferee is the mortgager or the homeowner who agrees to pay the donor's associated gift tax liability, which is...
No, the borrower is the transferor.
Yeah, that's... Oh, okay, I'm wrong on that one. The borrower or homeowner is the transferor. The mortgage company is the transferee.
And what does the transferor agree to do?
To pay the donor's associated gift tax liability. With a footnote. The property transferred is valued net of tax for gift tax purposes, and as a result, a lesser gift tax is imposed.
Okay, doesn't it say when you read your deed of trust, I hereby transfer all right, title, and interest in the below described property to the lender? Doesn't it say that in the deed of trust?
Yes, it does.
Okay, well then they're the transferee and you're the transferor.
Okay, so further explanation here. The usual purpose of the net gift is the donor does not wish to use his own funds to pay the gift taxes while still wishing to transfer the asset from his estate.
Okay, what does it say? Keep reading.
While the transferee is required to assume the tax liability, next page.
Can you see it?
Not move it up. We need to have the next page. Oh, over there, move it over.
Well.
Ugh. Let me see. Does not. Oh, that's really small. You took it out of my range.
Can you see that now?
Yeah, but you got to move it down. Part of it is cut off. You're going to make it just a little bit smaller. There you go. Now just move it down. I'm still missing just a little bit on the right side because the control panel's in the way.
I don't think I can move it over anymore. Let me try to shrink it down a little bit.
Now you can go down another jump.
Can you see that now?
Yeah, go down one more jump. A little bit smaller. So I can get past the control panel.
Okay, can you see it now?
Can you move it over to the left a little bit?
Well, let me shrink it down a little bit more. See, that goes into the double screen if I do that. And I can't move it over anymore.
Yeah, see, and my control panel's in the way. Broadly.
Move it out of the way then.
I can't. There's no way to move it. It won't move anymore. It's clear over to the... Let me see. Whoop, now I lost the whole thing. I lost you and everything. No, I can't get rid of the control panel. You have to start reading on page 2 because I won't be able to see it.
Okay, it says of the net gift 26 USC 2502C, which tells you that the donor is liable for the tax. Hereinafter, the Internal Revenue Code establishes the gift tax liability is the responsibility of the donor, thus the resulting complications. As a result of payment of the gift tax by the donee, the gift value cannot generally equate to the fair market value of the asset at gift. Revenue Ruling 75-72, 1975-1 CB 310 provides that for the gift tax valuation purposes, the gift value is equal to the fair market value plus minus the gift tax paid. Well, the gift value is the fair market value, which is the value of your estate. What you did is you donated a security, which has a market value. It has a market value of OID at original issue discount, plus it has a value at maturity. And that's what we're claiming. We're claiming the value, the market value at maturity, which is 30 years times the amount of the payments.
So if you take a payment schedule and they say you got to pay $1,232.79 per month in a mortgage payment, you would take that and multiply it by 360 months, which that's only 3 years times 10, right?
No, you multiply it by 30 years.
Right. Yeah. And then that gives you the fair market value of the asset?
Yeah, at maturity.
At maturity, which is the fair market value of the note security at maturity.
You're not paying you think that you're paying, your donation is on the security, the value of the security, not on the property, the real estate. Remember, that note is a security, not a note.
So our attendees need to understand you're not paying off the property. You are paying the tax on the security, which was never our responsibility. It always was the mortgage company's responsibility.
And I'm going to show you a case. If we read this, let me finish reading this. This income is recognized where the gift taxes payable exceed the donor's basis in the gifted property. Diedrich versus the Commissioner, 457 U.S. 191. The donee's resulting basis is determined by the type of transaction. Assuming there was no Dietrich type of gain to the donor, the donee's basis is the sum of the donor's basis plus any gift tax paid at time of gift related to appreciation of the asset, not to exceed the fair market value at the time of the gift. Treasury Regulation 1.1015-5A. If a Dietrich part sale, part gift transaction controls, Treasury Regulation 1.105-4 provides the transferee's basis is the sum of the greater of the transferee's payment or the...
Read that one Treasury Regulation thing, because you garbled.
Is Treasury Regulation Section 1.1015-4.
Okay.
Provides that the transferee's basis is the sum of the greater of the transferee's payment.
Now put that in English.
Well, the amount that you transferred, which is the value of the security, the amount that you transferred to them at closing is the amount of the tax they owe.
Okay, so the mortgage amount is the tax that the mortgage company owes, not the homeowner.
Can you see my screen?
Yeah.
Can you see? You read what that says? You read this case
Okay.
right here?
I will, but the last of it may be cut off. We'll try. The donor may be deemed to have paid the tax by ordering the donee to pay it to the
IRS.
IRS.
That's Sachs versus Commissioner. This is an IRS decision.
And that was 88 TC 769 to 778, 1987.
Okay,
Affirmed.
you can send a letter to the mortgagor, to the mortgagee, ordering them to pay the tax. Isn't that what that says?
Okay. By ordering the donee to pay it to the IRS, and okay, which was this case, IRS of Sachs versus Commissioner.
Yeah, it's 88. That's tax court. This is a tax court decision.
Okay.
I have all these cases. I'm going to give them to you.
Okay, so those will be the things that will be uploaded to me, and they will be provided on the file transfers with the webinars and the transcripts.
So if you read these, then you'll understand how they're ruling on this stuff, but you're not claiming this stuff. You're abandoning all this.
Okay.
It says a cash basis. Can you read the rest of this?
A cash basis taxpayer recognizes no income until the payment is made. Estate versus Commissioner, 685 Fed 2nd, 1160, 1162, 9th Circuit, 1982.
This is a California decision.
Okay. Dietrich's result is derived from a part sale, part gift analysis, although that analysis was not briefed to the court by the service. Duhl, D-U-H-L, and Qual, K-W-A-L-L, an analysis of Dietrich. 3, I can't read the rest of that.
It says Taxon, September 1982 at 1:30.
Okay.
And number 5 says Internal Revenue Code, Section 1015 D1A and Section 1015 D6, parenthesis, small d, small 6. 1015, parentheses D, small d, and parentheses 6.
Okay.
Now, why aren't people teaching this stuff in the Patriot community?
I have no clue. I guess it just took you to point it out so that we could go down the right trail instead of a rabbit trail. Let's take a couple more questions. How does this apply to state taxes dealing with the FTB?
The Franchise Tax Board taxes are predicated on the federal.
Okay.
That's how it applies. You can pay, I don't care how much the tax is. I can take you up, and we're going to go into it. We won't have time tonight, but I'm going to go on the FTB website. You can use an IOU to pay your taxes.
Okay, where does...
It says that on their website.
Okay, where does it state that W-2 and W-4 are Class 5 gift taxes?
It says that in the 6209 decoding manual.
Do you have filled in forms for examples?
We can do some.
Okay. Maybe you and I need to do that privately so that we can upload examples. As
Yes,
examples only?
We can. I can do that. I can do some examples.
Okay. Here, we do put the exemption on line 1. It was an error in statements. That was back on the other thing that we were putting on the 709. How about subchapter S corporations?
That's an estate tax. Those are corporate taxes. They still owe the tax.
Okay. Do you deduct the except for values that you file from that
Yes.
$2.5 million?
I've got somebody that went down there and they told them that they've got them on a pallet. They've got millions of these. They haven't even gone through them yet. That's why you haven't received the credit for it. They've got millions of these sitting on a pallet that they haven't got to because they don't have the staff to go through them. Everybody's doing it. The system is overburdened.
Okay. Do we get credit? Oh. Not even going to answer these nonsensical questions that come across here. If you don't get your question answered, it was nonsensical. Okay, we have a question here. People want to know how they can obtain your 3,000-page DVD where the IRS manual does it specify red ink, and your 197-page doc that you mentioned.
Are you talking about the decoding manual?
The decoding manual, and you have a DVD? People want to know how they can get that.
I have a 953-page treatise.
Okay.
It's 953 pages long.
Okay, so
it's $200 it's on a DVD.
Okay, it's on a DVD, so that's probably what this person was asking for, a 3,000-page DVD. Anyway, Gene said $200. If you people want these, you forward the payments to Gene, and we'll see that you get it downloaded. Will the net tax letter also be available? Gene said yes.
All this stuff, I'll make all this stuff available. This is how you learn, by getting, okay, now I'm going to go over this, why your loan was in default at closing. This proves it. This is an IRS document.
Okay, Section 856, definition of real estate investment trust. A, in general, for purposes of this title, the term real estate investment trust means a corporation, trust, or association, which is, number 1, managed by one or more trustees or directors. 2, the beneficial ownership of which is evidenced by transferable shares or by transferable certificates of beneficial interest. 3, which, but for the provisions of this part, would be taxable as a domestic corporation. 4, which is neither A, financial institution referred to in Section 582C2, nor B, an insurance company to which subchapter L applies.
Do you see page 2?
Just a minute. I got one thing it's right in the middle of it, darn it. Number 5, the beneficial ownership, something.
Can you see the screen now?
Yeah, you've got it all way up top. I got this control panel right in the middle, so keep going down. Keep going down. Okay. Keep going down. Keep going down. Okay, the beneficial ownership, you clicked it off. Go back up a little bit. Go up some more. The top of page 2. On the beneficial ownership. There it is, number 5. The beneficial ownership of which is held by 100 or more persons. Number 6, subject to the provision of subsection K, which is not closely held as determined under subsection H, and 7, which meets the requirements of subsection C. B, determination of status. The conditions described in paragraphs 1 to 4, inclusive of subsection A, must be met during the entire taxable year, and the condition described in paragraph 5 must exist during at least 335 days of the taxable year of 12 months, or during the proportionate part of the taxable year of less than 12. My goodness, would you please put it in kindergarten language?
Okay, that says that this is what you have to qualify to have a real estate investment trust. There must be 100 or more persons. You have a beneficial ownership in that because you provided the funds.
Okay.
But you're not claiming any of it.
Okay.
Well, if you own the funds, why aren't you claiming them?
I guess because we need to learn how to claim them.
Well, this is why I'm the only one that's teaching this. Okay, now what does this say?
Limitations. A corporation, trust, association shall not be considered a real estate investment trust for any taxable year unless it files with its return for the taxable year an election to be a real estate investment trust, or has made such election for a previous taxable year, and such election has not been terminated or revoked under subsection G. Number 2, at least 90% for taxable years beginning before January 1, 1980, of its gross income, excluding gross income from prohibited transactions, is derived from A, dividends. Got to go down a little bit.
Let me move this down. Can you see that?
Dividends, interest, rents from real property. Now you got to go up to the top of page 4. Pull it down. Or D, gain from the sale or other disposition of stock, securities, and real property, including interest in real property and interest in mortgages on real property, which is not property described in section 1221A1. E, abatements and refunds of taxes on real property. F, income and gain derived from foreclosure property is defined in subsection E. G, amounts other than amounts the determination of which depends in whole or in part on the income or profits of any person received or accrued as consideration for, move it down, entering into agreements. Small I, to make loans secured by mortgages on real property or on interest in real property, or II, to purchase or lease real property, including interest in real property and interest in mortgages on real property. Move it down a little bit. H, gain from the sale or other disposition of a real estate asset, which is not a prohibited transaction solely by reason of section 857B6 and 1 and L and I, big I, mineral royalty income earned in the first taxable year beginning after the date of the enactment of this subparagraph from real property owned by a timber real estate investment trust and held or once held in connection with the trade or business of producing timber by such real estate investment trusts. 3. At least 75% of its gross income, excluding gross income from prohibited transactions, is derived from, it's got to go up to the top of the next page over there. Move it up again. We skipped a page. You got to get to page 6. From A, rents from real property. B, interest on obligations secured by mortgages on real property or on interest in real property. C, gain from the sale or other disposition of real property, including interest in real property and interest in mortgages on real property, which is not property described in Section 1221A1. I read that.
You're on the wrong, you have to go to page
Oh, you
lower.
got to go down one page. I already read that once. Wondered why it was the same. Go down to page 7.
Well, there's 7 right here. Here's 7 over here.
Okay, abatements. E, abatements and refunds of taxes on real property. Income and gain from foreclosure property is defined in subsection A. We read that. Go down to the bottom. Go down to the bottom of that a little bit. Under H, under I. Qualified, let me see. H, gain from the sale or other disposition of a real estate asset which is not prohibited transaction. We lost it.
Can you see it now?
Keep going down a little bit. Okay, stop. Which is not a prohibited transaction solely by reason of Section 857B6 and, now go up to 8. A little bit more. H, and then that would be L, H-I, big I, qualified temporary investment income for, at the close of each quarter of the taxable year. My goodness, how long does this go? Let's put this in kindergarten language. These are all prohibited things, are they not?
Well, these are what's required when a property is foreclosed on. But if they didn't transfer the security to this trust, they didn't file a tax return.
So
They didn't file a tax return because they have to pay the tax. They haven't paid the tax because they never transferred the property. The property was in the loan was in default at closing because they never transferred the funds to the REMIC to get the tax exclusion.
Where they would be liable for the taxes.
Yeah, and then, so they're holding all this property as contraband.
Okay. Okay, so this is all what they're doing in order to have it in the REMIC trust.
This is, and let me go down here and we'll read what happens when it goes into foreclosure. They engineered this to happen because they never transferred I've got an Alabama decision. We won't have time tonight, but I'm going to go over it next week, where the judge ruled that the borrower was the third-party beneficiary.
And that case will be provided next week.
It'll be provided, yes.
Okay.
Along with this other stuff.
Okay. So to put all this that we've been reading into perspective, because nobody transferred the property at closing into the REMIC trust where the mortgage company would be liable for the taxes, they're holding all this illegally holding property that is defined as contraband.
Okay, read this. Read page 16. What does it say?
You got to go up page 16. Number E, special rules for foreclosure property. 1. Foreclosure property defined. For purposes of this part, the term foreclosure property means any real property, including interest in real property, and any personal property incident to such real property, acquired by the real estate investment trust. Nothing was acquired by the trust.
Right.
As the result of such trust having bid in such property at foreclosure, or having otherwise reduced such property to ownership or possession by agreement or process of law, after there was a default or default was imminent on a lease of such property or on an indebtedness which such property secured. Such terms.
Why would they say that the default was imminent?
I don't know. Why?
Well, because aren't all these mortgages ending up in default?
But
they're in default because they never transferred the money to the trust, the note. They never transferred the note to the REMIC to get the election to become a real estate investment trust.
So that's
so the
why,
property, the loan was in default at closing.
Right.
It has nothing to do with your payments. It has to do with they never transferred the loan to the REMIC.
Okay.
Okay, page 17, it says, what does it say?
Taxpayer must make election. Property shall be treated as foreclosure property for purposes of this part only if the real estate investment trust so elects in the manner provided in regulation prescribed by the Secretary.
So
they
have to file the return to make the election to treat it as a real estate investment trust. Well, they can't do that because they never transferred the property, the note. They never transferred the note or security to the trust.
So it's the real estate investment trust that has to elect
That's the taxpayer they're talking about.
And that is the mortgage company, not the homeowner.
Well, that's the trust that has to elect. They have to file the indenture trustee. The trustee that's overseeing the trust has to file the return and pay the tax. They're not doing that.
Which
and
they
the reason
never
they're not doing
because they never transferred it into the trust, so the trust doesn't have anything.
Right.
And when
they're the ones that are illegally foreclosing on all these properties.
Okay. And they have to do that under the for the taxable year that the closing took place.
Yeah, if they don't do that, then they haven't taken an election to treat the trust as a real estate investment trust to get the exclusion from the tax. So they owe taxes on all this capital income that they've acquired. So they're in possession of contraband because they haven't paid the tax on it.
That would be a wonderful discovery question.
Oh, yeah.
Now you can do a 4490 form.
A 4490. What is a 4490 form?
Okay, I'm going to show you. But let's get through this first, and then I'll show you what it is. See, it's terminated. Read page 19.
19, termination of election. Failure to qualify.
Okay, what do they have to do to qualify?
They have to transfer into the REMIC trust.
And then they have to file a return, don't they?
They have to file a return, which they have not done.
Which they have not done.
An election under subsection C1 made by a corporation, trust, or association shall terminate if the corporation, trust, or association is not a real estate investment trust to which the provisions of this part apply for the taxable year with respect to which the election is made, or for any succeeding taxable year unless paragraph 5 applies. Such termination, go up, such termination shall be effective for the taxable year for which the corporation, trust, or association is not a real estate investment trust to which the provisions of this part apply, and for all succeeding taxable years. Revocation. An election under subsection C1 made by a corporation, trust, or association may be revoked by it for any taxable year after the first taxable year for which the election is effective. A revocation under this paragraph shall be effective for the taxable year in which made and for all succeeding taxable years. Such revocation must be made on or before the 90th day after the first day of the first taxable year for which the revocation is to be effective.
In other words, they haven't taken the election, so they've abandoned it.
So they're the ones that have abandoned it, not the homeowner.
Right.
Okay. Such you booped it off. So they have 90 days to file this return, and if they don't, it is then abandoned property for them.
That's right. And they haven't filed the return because they never transferred the mortgage to the trust, to the REMIC.
So the trust cannot file a return because the trust doesn't have anything to file a return on.
Right. And so the servicing company who didn't transfer it has to pay the tax.
The servicing company is the one liable for the tax.
Or the attorneys who are assuming. That's why these attorneys come in there, and what they're doing, they issue a tax warrant. They call that a warrant of attorney.
Right. Where they can go in and make any agreement or contract with the court, whether it's in favor of their client or not.
Right.
That's a warrant of attorney.
That's a warrant of an attorney.
Okay,
We'll
so
go
when
into
you're
that.
in the foreclosure and somebody's giving you a default notice, that's the attorney or the group or the servicer company that we give these adverse claims to, right?
Right. That's who you serve it on.
Now, do we have to have a formal court case opened, or can we just serve them on it?
No. If you have a court case, you serve it on the court. We got one. They keep postponing it because they're going to have to pay the claim.
Okay, so if you don't have a court case, you serve it on the servicer. If you have a court case, you serve it on the court or the judge?
Yes.
Is that by filing it into the case or privately process serving?
File it into the case.
The adverse claim gets filed into the case.
Yes.
Okay. If you got a court case, you file it into the court case. If you don't have a case opened against you, then you serve it on the servicing company and or the servicing company's registered agent or attorney group trying to foreclose. Right?
Right.
Okay. And you will be supplying this adverse claim format to be uploaded to our attendees, right?
Right. You're right. I will.
And some of these other documents here that you're pulling up.
See, read this. Here's what happens when they don't make the election.
Okay, A, which is not a real estate investment trust. Where am I reading?
That's where you're reading.
Okay, to which the provisions of this part apply for the taxable year due to one or more failures to comply with one or more of the provisions of this part other than paragraph 2, 3, 4, or of subsection C. Such failure, number B, such failures are due to reasonable cause and not due to willful neglect. And C, if such corporation, trust, or association pays as prescribed by the Secretary in regulations and in the same manner as tax, a penalty of $50,000 for each failure to satisfy a provision of this part due to reasonable cause and not willful neglect. Oh my God, how many parts and subparts did we read? At 50 grand a shot.
Yeah.
Listen to this.
You think these people won't run from you?
Let's see if we have some more questions. Hold on just a minute. Got to bring them back up here. I got to get back to where I was so I don't skip anybody. Where did I quit reading? I go to get back up to where some of these questions are. Red ink. Okay, the manual. Where in the IRC manual does it specify using red ink?
They have a manual that says that.
Okay, but can you
We
identify?
can go into that next week.
Next week. Keep that in mind, folks. The red ink issue will come back next week.
Okay, can you see the screen?
Yeah. Proof of claim.
What does that say?
Proof of claim
Can you
for
read it?
internal revenue taxes. What form number is that?
Can you see it better now?
No. I don't see the form number. I see the form, but not the form number.
It's a 4490.
4490 form. Oh, there it
Can you
is.
see?
4490. Okay.
Can you see it now?
Yes.
Can you read? Can you read what it says?
It just says proof of claim for internal revenue taxes. The rest is there. It's a little bit bigger. The undersigned officer of the Internal Revenue Service, a duly authorization of the United States in this behalf, being duly sworn, deposes and says that the debt is for taxes due to the internal revenue laws of the United States as follows. Kind of tax and period. Unpaid assessment balance. Accrued interest, accrued late payments, penalty, interest, total, date, tax, lien, accrues.
Okay, it says kind of tax. You put gift down here. Unpaid assessed value. You put the amount of the loan there.
Okay, wait a minute. Column 1 is gift. Column 2 is the amount.
Yeah, the unpaid assessed balance.
The balance, which would be the mortgage.
What's the date? An accrued late payment penalty.
Would be
it's
the
50,000, isn't it? Under 856. Did
yeah,
it say
but
$50,000?
yeah, but that was per section.
Yes.
So you add up all the 50,000s.
Right.
Okay. Accrued interest. I don't know what that is in column 3.
Well, that's the late payment. They haven't made the tax payment, have they?
Right. So isn't that the penalty, the $50,000 times each section that they didn't do?
Right.
And then you add up the total and the
Yeah,
date.
well, then okay, when was the date the tax lien arose?
Closing.
Yeah. Because they never transferred it. That's the date of the mortgage.
Okay. Man,
Okay,
I got 7 houses to go after. Woo-wee!
Okay, what does number 3 say?
Number 3, no part of this debt has been paid and it is now due and payable to the United States Treasury at the Office of Internal Revenue Service. Number 4, except for the statutory tax liens that arose on the above date, the United States does not hold to the deponent's knowledge or behalf any security for this debt. Number 5, no note or other negotiable instrument has been received for this debt or any part of it, nor has any judgment been rendered with respect to this debt. And 6, this debt has priority and must be paid in full in advance of distribution to creditors in the X something provided by law, to the extent provided by law. See 31 U.S.C. Section 371, 3713A. Any executor, administrator, or other person who fails to pay the claims of the United States in accordance with its priority may become personally liable for this debt under 31 U.S.C. Section 3713B.
Do you know what that says?
Say it again in kindergarten language.
Do you know what 31 U.S.C. 3713A says? You want to, okay, we're going to pull it up and look at it. But do you see, now this has to be notarized. See where it says subscribed, is sworn before me?
Yeah. But up above it says undersigned officer of the Internal Revenue Service. We're not officers.
Who said you're not?
Explain that one.
If you've got a Social Security number, you're an employee of the United States. Can't you sign this? What you should do is call up the Internal Revenue Service and tell them that you want them to fill this. Send them the form with the information in it.
And
send it in for them to sign.
Get
them to sign it.
Or take it into an IRS office?
Yeah.
Okay. Okay, we got another question here. The Supreme Court said that we were to have the remedy of writing off debt since we have no money. This person wants to have that. What is the case and where do we find it? That one we've got. We'll make sure that that's provided.
We'll provide you with that case.
Okay. Is Jean making us pay for the docs? No, it's with your webinar. Is Section 856 out of Title 26? Duh.
Yes.
Are you saying that you donated your land to the town and that you can send a letter to the town to pay the tax and it is deemed paid? You are not talking about property tax, is that correct?
You're talking about that's what they're charging you for. You can make them pay the tax on the donation.
Right, but you don't, if the town doesn't pay it. It's the servicer that was supposed to transfer your note security into the REMIC. So you don't go after the town.
Well, you're talking about two separate issues here. You're talking about property taxes.
Property tax and the note security is two different things. So if you have property taxes, you have to do an adverse claim to the treasurer because they're the ones that they're not being the trust, real estate investment trust, and they have not filed the return to do that. It's all the same thing, isn't it, Jean?
Yeah.
What if the original note is still held and serviced by the original bank? It still was not transferred to the REMIC. You still don't have the trust and they still didn't pay the taxes.
That's
yes,
why
it
this
applies.
is. So what's really going on is they're in possession of contraband, aren't they?
Right. Would you file it in the bankruptcy court against the trustee to the court? No. You file it against the mortgage company servicer for not transferring to the REMIC, for the REMIC to file the return, and you add up all the penalties at $50,000 a whack for each one of those sections that I halfway read, which we're going to get that document from Jean. You just start adding it up. Yes, it goes against the attorney who's come against you. Now it says Form 2490 is no longer available on the IRS website.
Well, I've got it right here.
He's got the form, so we will provide it.
We'll provide you with the form.
Prosecutor in a traffic case. Do we bring in Form 4490 against the prosecutor?
Yes.
Okay.
Tell him to pay the tax on the transfer.
Okay, so then we would file the 4440 form, 4490 form into the case and tell them to pay the tax.
You don't believe that this will work? Here is can you see my screen?
Yes.
Okay, what does that say?
Atlanta file e-notice. Judge Albert Johnson. Wooten Nicholas Heath.
What's the date on this?
30th of March 2011. Hey, that was last week.
No,
Yesterday. No, today's the 2nd.
Thursday.
Yeah, that was Thursday.
Yeah, well, what does this say? Read what this says.
Kathy Coulter, Circuit Court Clerk. Go down some more. Order. This cause comes before the court for hearing on March 21st, 2011. It is hereby ordered, adjudged, and decreed. Following hearing and review of all submissions from the parties, the court has come to two conclusions necessary for the disposition of this case. First, the court is surprised to the point of astonishment that the defendant trust, LaSalle Bank National Association, did not comply with the terms of its own pooling and servicing agreement, and further did not comply with New York law in attempting to obtain assignment of Plaintiff Horace's note and mortgage. Second, Plaintiff Horace is a third-party beneficiary of the pooling and servicing.
Who is this plaintiff?
The plaintiff is Horace.
And who is Horace? Is that the borrower?
That's the borrower, yeah.
Okay, what is the judge saying?
Is a third-party beneficiary of the pooling and servicing agreement created by the defendant trust, LaSalle Bank National Association. Indeed, without such pooling and servicing agreements, Plaintiff Horace and other mortgagors similarly situated would never have been able to obtain financing. Consequently, plaintiff's motion for summary judgment is granted to the extent that defendant trust LaSalle Bank National Association is permanently enjoined from foreclosing on the property known as Knowles Road, Phoenix City, Alabama. Further, the court is of the opinion there is no reason for further delay as to the entry of final judgment concerning the issue of foreclosures by the trust LaSalle Bank National Association. This notice shall issue to the parties 25th day of March 2011. Man, every foreclosed person needs to have this order.
Okay, what is this judge telling you?
He's telling you not only that LaSalle didn't meet its own pooling and servicing agreement things, but this applies to all other mortgagors similarly situated.
Duh. Now, how can you, let me ask you a question, and I want to see if you're thinking. How come Horace is the third-party beneficiary?
To the pooling and servicing agreements, It's because the mortgage is it's a trust. It's a trust.
Yeah. But how did he become the beneficiary?
Because the mortgage is also the mortgage is what? Let me ask a question. Maybe something's on our thing. Okay, we've got something on the board here. I'm looking at the trust was actually created by Horace, right?
Yes.
I get an A.
The trust he's the grantor settler.
Of the trust.
So he owns the funds.
So he is a third-party beneficiary because the pooling and servicing agreement is part of the grantor settler's trust.
Right, and he's the donor. He provided the funds to the trust. That's why he's the donor, grantor, settler, because he donated the funds, which made him a beneficiary of the pooling and servicing agreement.
And
another way of saying that is he's a undisclosed third party to the pooling and servicing agreement. He has the same rights as an investor. Are the investors getting paid on this? Yes.
No.
Can you get paid? Yes.
Okay. As an undisclosed third-party beneficiary. Right?
Here's living proof of what I've been trying to tell people for 15 years. This is all coming out now. I was teaching this 15 years ago. Nobody would listen to me.
Well, because you were clear up in the stratosphere and nobody could understand what you were trying to say. Now that you're showing people the sections, the forms, the documents, this order, now it's starting to make sense.
What I'm doing is taking all the pieces and putting them together, and it forms a picture.
Right, and that's why these webinars are so important. We got one of our attendees said they found Form 4490 by Googling it.
Yes.
So it doesn't matter what the entity is, the traffic case, a contract case, a criminal case, a civil case, a divorce case, a this case, a that case, doesn't matter. If you give them the 4490 and tell them to pay the taxes and prove that they have paid the taxes by providing the receipt for the bond that paid the inheritance tax, they're screwed. Right?
Right. What's your first clue?
They didn't file the return. They didn't transfer anything into the REMIC trust. Does REMIC trust cover other things other than real estate property?
Yeah,
does it not cover everything?
Yes.
Because the pooling and servicing agreement would be like the Chris report for the judges, would be like the clerks that send out the defaults that fine you, and the cops that come and pick you up and put you in jail. All of those entities are really executing on their pooling and servicing agreement that they're trying to claim when they never filed the return or never transferred everything they took in to a REMIC for that situation, right?
Right.
Okay.
So they're in possession of contraband because they haven't paid the taxes on it.
Okay, so we've got about probably 10 more minutes, Jean.
So what you want to do is you want to report them to the IRS.
And that's on that 4490 form.
Yes.
Boy, are we going to get a hassle of those forms. I got 30 years to go after.
Now, are you starting to get an idea of what's going on?
Yeah. It's hit me over the head like a metal skillet.
These people are in possession of contraband because they haven't paid the tax on it.
Right. But more importantly, when we list all of those penalties on that 4490 form, who gets the penalties? Do we get all that in our pocket, or do those entities have to pay?
They have to pay the IRS for that. They owe that money to the IRS. They're in possession of contraband because they haven't paid the tax on it.
And that becomes an IRS lien on them.
Right.
Okay. Let's see if we, oh, I messed up my things here again.
Can you see my screen? I'm going to show you what you guys, because you don't understand. Now you know what I said. You show me anybody that's teaching this today. Can you see my screen?
Yes, we needed to go over the, we had some questions earlier on the pay to the order paragraph.
Let's go over this. You know when you get a utility bill?
Yeah.
And they have that coupon at the bottom?
Yes.
Okay, what does it say on here? Can you read this?
Where do you want me to read? Coupons, section 21.
Yeah, read it.
To facilitate the quality of negotiability of public bonds in bearer form, it is customary to attach to a principal obligation coupons containing promises to pay to the bearer, as stated at stated intervals, interest on the debt.
You've got the coupon. They issued you a coupon. How come you haven't redeemed it for the debt?
I guess we're trying to learn how to do it. By means of which payment of the interest is received as it comes due by clipping or detaching the coupons and presenting them to the issuer or the designated agent. Interest coupons are also sometimes attached to other instruments, such as notes or warrants, and are sometimes called interest warrants. Such coupons are written contracts for the payment of a definite sum of money on a given day, thus constituting...
Read that again.
Such coupons are written contracts for the payment of a definite sum of money on a given day. Thus,
read it again.
Such coupons are written contracts for the payment of a definite sum of money.
So you got a written contract for the payment of money, and that coupon is the money to pay the contract.
Thus constituting a note or bond, and in the form in which they are usually drawn are negotiable instruments and are negotiable separately from the principal obligation.
And why aren't you endorsing these and sending these back in for payment?
Okay, and that's what you do with the red ink signature on the on what you're going to talk about next week on how to do that and what to say on that little paragraph.
We'll go into the
Okay, we'll take a few minutes.
I paid off I paid off an $80,000 court judgment doing this. If you want to know if it works, ask Toby. Toby will tell you.
When do you get notice that it's worked? Do you get anything back from IRS, or do they let you know that the obligation is taken care of, or how does it work? Say somebody does that on child support for 18 years for a child.
Well, then when you report that as interest or income, then you get the refund. You get the money back.
So if you've
that's your redemption.
If you have
that's how you get redemption, and nobody's doing this.
Okay, so now if the court is still coming after you for that child support, or the child support division is still coming after you, or a traffic ticket is still coming after you, or a court judgment is coming after you, or a breach of contract, do you
take
list
the court judgment, endorse it, pay
right?
to the order of.
Yes, and do you also list those on the 4490 if they continue to come after you?
Yes.
Yeah.
Yeah.
I think my life has got a whole lot simpler.
Is this retribution?
So now, let's get back a little, because I'm going to bring this down to different situations for people so we can really understand it. I'm going to use my own situation for clarification. If you have paid to the order of child support, is the ex-wife or ex-husband liable for that? Or is it the court and the attorney liable for that ordered that?
Yeah, they're the donee.
Who? The court?
The court is.
Or the wife or the husband?
Isn't the judge acting as the executor or administrator of your estate?
Okay, but that's like in my situation, the ex-wife is the one going after all this stuff wrongfully. So now,
well, appoint the judge as the trustee.
So if you sent in a pay to the order to the attorney, DBA, the ex-spouse, who gets
you want
the
to make it
tax
pay? If you want to get a refund, you make it payable to the Secretary of the Treasury, which is the International Monetary Fund.
Right, which you did.
Then you charge it to the attorneys.
Right.
Charge the sum said to the attorneys or to the court, and put down their address, and then say credit the amount to the account of you. You credit that, then you get that refund back.
How
you
long?
File the return.
How long does it take to get the refund back?
About 60 days.
Okay. Just wondered on that. And it doesn't matter whether it's child support or it's a contract issue or it's self-employment tax issue or it's a civil suit or a court judgment, attorney's fees. It all applies.
Right.
Attendees, I hope you're listening very carefully on this. Class members, there isn't a situation out there that this does not apply to.
All writings are, let me see if I can find this real quick. I want to show you something real quick. And this is, I'm just showing you that people do not understand commercial law.
Oh, we're trying. My goodness, we're trying. Okay, so if
wait, you see this. This will blow you away.
Oh my goodness. So if you have had a court case and you've been charged with something and they found you guilty and now you're waiting to go to sentencing, that amount, how do you figure an amount on that? Is it so much per charge that they've convicted you of? Or how do you do that?
Yeah, tell them you want a statement of accounting under 9-210.
Under UCC 9-210.
Right.
And that would be a discovery question before you went into sentencing, right?
Right. What do you think I did to that's what I did with Karen. Now they're playing, let's make a deal.
Really?
Okay.
And that's Karen, what's her name?
Yeah, Karen Tappard, yeah.
Where they went in and charged her all that money and all those counts and supposedly convicted her and all that?
Yeah, I bonded the case for $10 billion.
Oh,
they owe $10 billion.
To IRS. Because
read what's,
each
can you
count,
read?
listen to this, Gene. Each count, I just had a brainstorm. Each count that they've charged you with, you go back on that other thing that added up all the violations and penalties, and each of the sections that they violated applies to each of the counts, right?
Right.
Woo!
Right. What does this say? Can you read my screen?
Where, what am I reading?
This is
Writing
what
and
is
other formal requirements.
What does that
Bills
say?
and notes. Only a writing may constitute a negotiable instrument. The terms written or writing include printing, typewriting, or any other intentional reduction to tangible form. The requirements of a negotiable instrument may be expressed in a letter as well as in more formal documents.
Would you repeat that again? Read that again.
The requirements, listen carefully, guys, the requirements of a negotiable instrument may be expressed in a letter as well as in more formal documents.
So you can pay a debt with a letter. It says a letter is a negotiable instrument.
That's what it says. Hey, guys, we got to take note of this. This is Section 39 under what? Go up.
11 Amjur. Let me scroll up, and you can write this down. I'll give you copies of this. This is 11 Amjur the second.
Okay, 11 Amjur second. 11 Amjur second, bills and notes, subsection 39.
You're going to get copies of all this. I've got 39, 40, 41, 42, 43, 44. I've got all these documents I'm talking about.
Wonderful. Man, this is just beginning to get really exciting. So with that, Jean, I think we're out of time for tonight. We hope all of our attendees will come back next Saturday to continue this. And this is a mind-blowing session we had tonight. I'm so excited. And so with that, I guess we're done for tonight, Jean. I'll stop the recording. And guys, we will head into next week. Thank you so much.
I love you all. Come back next week. I'll give you some more.
We love you all.
Manna from heaven.
And we are so grateful for all of your attendance and knowledge and coming to learn this very important information. Thank you so much and good night.